Hey guys, welcome back to the channel Let's Make a Mill, where I'm basically documenting my journey towards making $1 million, and I do that by investing into the stock market, such as an S&P 500 index. I also invest into REITs, which are known as real estate investment trusts, and I also invest into real estate and real estate syndications. And today we're going to go ahead and give you an update on the portfolio and tell you kind of what's been going on since my last video. So we'll dive right into it. This is the income portfolio. It's no longer the REIT income portfolio because I added mortgage REITs and also added BDCs, which are known as business development companies. All right, so right now we're sitting at a portfolio of $139,000 with a $10,000 loss and dividends in the $4,000 range. All right, so just to explain a couple things, because it has been quite a while since I did an update. I think the last update I did was in the beginning of 2022, so it's almost been, a year and some change, maybe a year and a half. And there's been a lot that's been going on. Obviously, the stock market's been taking a nosedive, as of late, but it has been on the run up these last couple of months. People think we're in a bull market, but it's being driven by the AI boom. But as far as real estate's concerned, there's a lot of talk out there in the public that, real estate market crash, recession, the housing market crash and blah, 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 blah. And it's just so much noise. But I'm here to tell you, just based on my own reading and my own analysis and my own research, a lot of that is just, well, for lack of a better term, BS. The interest rate is affecting the real estate market. It has obviously cooled it down from the old 2020 and 2021 highs when interest rates were near zero. But as far as real estate investment trusts are concerned, they're positioned very well. They don't have a whole lot of debt. They're not leveraged like they were in 2008. Everyone's trying to say that, this is going to be the next 2008. Everything's collapsing. The banks are collapsing. Real estate mortgage notes are due, and this is going to collapse the whole real estate market. Some of that is sort of true. There is mature debt that is maturing for these real estate companies, and they obviously need to pay. But as far as REITs are concerned, they're not doing bad. Their balance sheets are stronger than ever. Rents have been increasing over time, and maybe the bad REITs, the REITs who are over leveraged, yeah, they're gonna definitely feel it as their debts become due. But I don't think good REITs are gonna do bad. I think right now the REITs that have been sold off, like the infrastructure REITs, AMT and CCI, are mostly due to overreactions. Just my thoughts. I'm not a REIT expert. All right. I'm just a guy who records stuff on YouTube. Of course, you should always do your own due diligence. Anyways, continuing on with what happened. So as you can see, there's two huge bumps here and then another huge bump here. So I want to talk about another topic, and that's FOMO. FOMO and chasing yield. So I was a sucker for yield for a little bit. I was investing into QYLD, XYLD, and RYLD, which have those mouth-watering, 10, 11, 12% yields. But I was investing in them for a couple of months. I was making consistent income. I think off $40,000, I was making about $300 a month or so, maybe a little over 300, and it was good. I mean, that's really good, passive income. And then, over a year, you're talking, almost $2,000 or almost $3,000, $4,000 in passive income. But it came at a high price. My capital was depreciating and eroding over time, and I was not a fan of that. If you look at QYLD today or RYLD or XYLD, I mean, the capital growth hasn't really been there, and there's always two sides or two camps that says you always have to reinvest a dividend, which is true. And some are just like, no, that the funds are going to zero, just get out while you still can. And I didn't lose any money on those investments, but I also, kind of didn't make any money, and I just got out before anything else, before I could really make a terrible mistake. And that went on for about 3-ish months. So nothing too bad. So anyways, it was about a $40,000 pot, and I cashed out of all that money, and then moved it into the equity REIT portfolio. I was thinking, you know what, I have to think long term. I need to stop chasing yield or these sucker yields, and I need to stop getting into yield traps. I need to be a real, I need to invest like I should. Don't chase the yield, don't FOMO, because that's how I lost money in the past with crypto and with meme stocks. So I really looked hard at this portfolio. I said, you know what, this is my buy and hold long term passive investment. I'm not chasing yield. So I sold out of all those and moved the money into the equity REITs, which is kind of why you see this massive jump from 50,000 to 82,000, right? And then REITs kind of just been trading sideways. There's been a couple false bull markets. And again, it's all because of the interest rate, right? The Feds, announcing that they're hiking and then that they're going to stop it, but they're still going to continue. And that's kind of why stupidly, I bought when I bought at the height of this month for REITs when REITs were doing very well. And then the Fed announced that they're still going to continue interest rate hikes. And then, the whole REIT market basically just went down from there. It was an oversale, I guess, or oversold. I don't know. But, all in all, it was, I knew that was going to happen. I should have waited. I know timing the market's a bad idea, but if you look in the past, you can find that every time the Feds, were coming up on either a rate hike or they're waiting to see what the Feds were going to do, the market was doing very well. And then every time the Feds made their announcement, the market always takes a dive. And it's been like that for a while. Or at least that's what I've noticed. I could be wrong, but that's just what I noticed. So I should have waited, but whatever. It's not a big deal. So why this big jump, right? Where did this big jump come from? This big jump came from me exiting Fundrise. So yes, I exited Fundrise. I'm consolidating a lot of my investment accounts. Fundrise is a good platform to invest in real estate. I'm not going to discount that. They're doing a lot of new cool things. Their platform is way better than it used to be, where you can invest into individual E-REITs or E-funds, which is really nice because you can invest strictly for income or strictly for growth, or if you want to take advantage of some of their more opportunistic investments like their credit fund or the other types of funds that they have, all the more power to you. I think it's a great way to diversify your holdings, right? Your overall portfolio. But I wanted to consolidate because Fundrise is mostly invested into, multifamily, single family homes and with stuff in warehouses or industrials. Hey, but what do you know? I also have industrial REITs, apartment REITs, and I also have, single family homes. And they also, Fundrise also, I believe invested into manufactured housing. I believe, I could be wrong on that, but I thought I saw some investments there. But hey, what do you know? I'm in two of the best manufactured housing REITs out there. So basically, I cashed out of Fundrise, moved the money into the equity REIT portfolio and amongst the MREITs and the BDCs. And, this is where we are today. So I haven't sold. There's been a couple comments, asking, hey, did you sell? Or what's the latest update? So I'm kind of responding to all that. This is the latest update, and this is kind of where we're at. REITs are doing very well this go around than they did in 2008. They're positioned very well, at least quality REITs are. They're positioned very well. Their balance sheets are strong. Rents are increasing. They're still able to lease their spaces. Now, there's a lot of talk on the news and out there in the media. Oh, the real estate market's going to crash. Don't buy real estate. Well, that is true for some sectors, not all sectors. Like, let's take, for example, the multifamily apartment REITs, right? I mean, everyone needs a place. Everyone needs a place to live. That's the bottom line. Everyone needs somewhere to live, and I think having apartment REITs as part of your portfolio, everyone kind of lumped these in with general real estate, and they had a huge sell-off. But I think that was misleading because the sectors that are affected real badly, in my opinion, are office REITs and malls. Malls, they're they're a dying breed. I think they have more headwinds than they do, tailwinds. More stuff that they're going to have to deal with in the future, more than stuff that's going to boost them forward, i.e. Amazon. Amazon is crushing it, and retail is being done a lot more online. Very few people are still going to malls. So just my 2 cents is all. Same thing with office REITs. From the work from home, everyone wants to work from home. Everyone's willing to take a pay cut just so they could work from home. Everyone's willing to, move to another city outside of the expensive living areas so they can just work from home for other companies or whatever have you. It's COVID kind of, exacerbated that theme that you can still work from home and accomplish the same amount of work. Right? There's no need to go to an office space and spend 5 days over there where you interact with coworkers. You probably don't get as much work done, if not the same amount of work done, working from home versus working from the office. I get that there's a lot of there's a lot of people out there that say no, collaboration happens in the office space, which could be true, but Zoom, with products like Zoom, Microsoft Teams, Google Chat or Google Meets, all those other platforms out there that do video conferencing, what's the point? Now you're collaborating for real just over the internet, right? So it's kind of a weak argument in my opinion, but we'll see. We'll see. I mean, of course you still have like doctors that need to go to the hospitals, or engineers that probably need to do a lot more work in person to collaborate or whatever have you. Scientists obviously still need to go into the office. So this is just kind of my thoughts on when people say the whole real estate market's going to crash. No, the whole real estate market is not going to crash. Now, is there a lot of bad REITs out there? Sure. Are they over leveraged? Sure. Are they going to probably have some horrible next couple of years? Absolutely. And with the interest rate with the Fed, they're gonna hike it again 2 more times this year, or at least that's what the consensus is. No one knows exactly what they're gonna do, but that's what the consensus is. So while real estate is really cheap right now, I plan to continue to buy. If we look at V&Q and take a look at how they've been doing, they have not gone up very much this year. Actually, contrary, they've just been going down. This is the little mini bull market. I bought right here at the top, and just boom, like that was kind of silly of me. I could have bought more shares at cheaper prices, but I digress. So if we look at V&Q, it's just had a terrible year. It's just rate hikes, interest rate, the economic fears, and inflation running rampant, and yada yada yada. Right? It's just a lot of stuff that's more of a headwind for real estate as a whole. And then along with the collapse of the couple of banks that just happened, that just put further fear on the real estate market. But if we look at let's say the S&P 500 index, we're going to look at ticker SPY. They've had a pretty okay year. They've just been going up, but I think a lot of this right here has been due to the boom in AI, with ChatGPT and all these new AI products coming out. You have NVIDIA that's, just crushing it right now. You have Microsoft. Apple's doing really well. This is being led by a lot of the tech sector. And if we look at the tech sector, QQQ, which it follows the NASDAQ 100, they've had a phenomenal year. You're talking, I don't know, like year to date. Come on, this needs to update. Well, they've had almost like a 20% return, or more than that, actually. I think it's closer to 30, but they've had a great return this year. And of course they did because, of the AI boom. And it seems, the reason why they had a huge drop in the last 2 years was because the companies who weren't making money, that were the darlings back in 2020 and 2021, and then it just, the interest rates just crushed them. And as you can see, a lot of these tech companies just were going down the drain, and this was the time to buy if you were a tech type of person. I still don't have any tech. I did invest in QQQ for like a little bit, and then I just got out. Again, my overall investment strategy is cash flow. QQQ, if you could get it straight to $1 million and then start taking money out, that'd be great. But I don't want to sell any of my shares, which is why I don't invest really into QQQ or the tech sector. I just invest in a plain old S&P 500 index in my retirement accounts, and that'll be that. I know, I'm still fairly young, and a lot of people say, no, you need to buy, tech stocks. You need to buy, growers and all that. I mean, that's cool. Yeah. I mean, be my guest. But if you look at a lot of those tech stocks, those darling tech stocks that were the hype of 2020 and 2021, they're basically zero at this point. I think there's one called Helion. Some of y'all might remember this one. If we look at that one, not doing too well, not doing well at all. As a matter of fact, they're probably gonna lose. They're probably gonna lose or just go bankrupt at this point. There's another one. I think Workhorse was another one that I kept hearing about. And man, it's just that's so sad. Let me just look at those charts. These were the darlings, and now they're just worth nothing. Imagine being an investor way at the top, and now your investment's pretty much nothing. So anyways, I digress. I go back to just buying real companies. These aren't just pieces of paper. These are real companies that have a lot of people behind them, intelligent, smart people behind them, and they own real assets, right? They own real estate. They own infrastructure like towers. They own multifamily apartment buildings or complete apartment complexes. Storage. Huge facilities of self-storage, thousands of units. I don't know, it's just single family homes, tons of homes, right? So I buy assets that are going to obviously produce a return for me in the form of a dividend, cash flow, and that own physical real estate. I'm a huge real estate person. I really like real estate. I may not always be the smartest in the room with real estate, but I love real estate, and that's all there is to it for me. I mean, since this time, if you've been following the channel, you knew I had a couple rentals. I sold most of them off. I think I only have one more. The rentals became kind of a problem, and then I was moving into kind of multifamily apartment complexes. I ended up investing into a huge 380 or 370 unit apartment complex through a syndication, and ever since then I've kind of just been on the prowl for more real estate and selling my real estate. So I pretty much sold everything and moved it either into REITs or moved the cash into real estate syndications, and I'm also holding cash just for a rainy day. So that has been me over the last couple of years. Basically the last couple of years. And let's get into this portfolio update. All right, so infrastructure REITs, industrial REITs, apartment REITs, triple net lease REITs, storage REITs, manufacturer housing, data center, blah, 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 blah. Cannabis REITs. I'm going to go into each one and explain kind of just from a high level what each of these are. Right, so we'll start with the infrastructure REITs. So I invest into American Tower and CCI. Now they've been battered down, huge, like really beaten down, and it's because they are predicting slower growth in the next couple of years, and rightfully so. I mean, they are, one, eliminating debt, and which is a smart thing to do, and two, with interest rates the way they are, it's going to affect their growth. It's going to affect them able to take on new debt, and they obviously have to pay off old debt. So both AMT and CCI, and there's more to it to that as well. I mean, more specifically, I think it's CCI or AMT. I can't remember who is dealing with the churn from the Sprint T-Mobile merger. I think it's CCI, to be honest. But yeah, even both of these companies, they both announced that they're going to be seeing slower growth over the next couple of years, 2 years. And then they'll be able to see it pick up back in about 2025, maybe 2026. So again, being a long-term investor, I'm buying shares, hand over fist if I can, because I know in the next couple of years they're going to pick back up. And I'm not worried about the share price. I'm worried about the company. I'm more worried about the company than anything. But AMT and CCI, they have excellent management teams. They're not dummies. They've been around for quite some time, and these are huge compound growth type of companies. They produce a pretty, probably average dividend yield between the both of them. But again, this is a long-term hold, and while I wait, they're going to pay me a dividend, and I will just keep on buying them on the cheap. I mean, you're talking almost, I won't say cents on the dollar, but you're definitely, maybe buying, I don't know, maybe 75, 80 cents on the dollar for their real estate, which is really good. So moving into industrial REITs. So industrial REITs, they deal more with, warehouses, logistics, storage, not self-storage, but storage of product. PLD is the biggest player in the space. And again, they've also been having their own shares being sold off. I bought PLD at a very good price, so it's still up, which is great. Turno is also, a similar type of company. I've been buying them a lot. I used to have Rexford in here, and I don't remember why I sold it off, but I did sell it off, and then just moved the money into PLD. And then I have a Maricold Maricold Realty Trust, which is a cold storage REIT. It's a very small sector within the REIT industry, and there's a lot of let's say micro players throughout the United States. So at some point there's going to be a consolidation effort, either through mergers, acquisitions, or what have you. And I think Cold will come out on top. It's one of, I'm not sure how many other REITs do this type of REIT type of, I guess, purchasing, of cold storage. So I thought it was just an interesting play, and I wanted to get some exposure to it. So that's why I purchased into Maricold Realty Trust. All right, going back, if we look at the apartment REITs, no big brainer there. I mean, I'm a huge fan of apartments, and it's actually the space that I'm working on currently is to purchase multifamily investment properties. But I also invest into multifamily apartment REITs. And these are the biggest players in the space. There's two more, or one more I could think of, MAA. I can't remember, Mid-American Apartments, I think is their name. But I don't own that REIT. But EQR, AVB, ESS, CPT, these are, your run-of-the-mill apartment REITs. There's nothing sexy about them, which is what I love. There's no new technology. There's no sexy thing under the hood. They're simple businesses. They purchase real estate. They develop the real estate, and they lease to tenants to rent for income. I mean, that's all there is to it. They run very easy, stable, predictable operations. There's nothing about these REITs that are revolutionary and mind blowing, which is what I like, because again, I want predictable cash flow. EQR, AVB, ESS, and CPT, again, huge sell-offs, but they're all positioned very well. And if I'm not mistaken, the North American Real Estate Investment Trust organization, NAREIT, they produced a paper saying that almost all the REITs, I won't say all the REITs, but they made a statement that a good majority of REITs, their balance sheets are strong. They're not over leveraged. Rents have been increasing over time, and they haven't really saw much, if any, effect from anything. Interest rates, economic crises out abroad, recession, all that stuff. All the REITs are ready for this recession. They are all prepared for a recession, and again, it's all because of their responsible management teams. So these are the REITs I invest into. I'm not saying what you should invest into, but these are the REITs that I find have been good stewards of my money. And if I had a lot more money that I could use for REITs, I'd probably continue buying multifamily apartment REITs, and I will continue buying multifamily apartment REITs. They're just, man, for me, apartment REITs are where it's at. again, very boring business model. Nothing exciting. Triple net lease. All right. So for those of you who don't know what a triple net lease is, and we do have a new investment. For those of you who don't know what triple net lease is, triple net lease is basically these REIT companies. They'll buy a building or buy, whatever. They'll buy a certain amount of buildings and lease the space out to commercial tenants, i.e. like Burger King, McDonald's, maybe like a Cheesecake Factory, Texas Roadhouse, whatever, right? They own the real estate. Dollar General, so many others. But they own the real estate. And what they do is they put the tenants on a lease called, a triple or 3NNN. And basically what that means is the tenant is responsible for, not only the mortgage, but the taxes, the insurance, and the repairs and maintenance of that property. So the REIT operator just owns the building, and it works out very well. As far as the leases, they're designed in a way where the occupant pays a certain amount for a certain period of time. So think like if you were to purchase your apartment, right, or get into an apartment, and you make a deal with the landlord to say, hey, I'm going to pay $1,000 a month for the next 5 years, and you can't raise the rents on me. That is basically triple net lease, and in return, I'll pay for all these other expenses. That's basically how these companies run, right? So they have these leases that they put their tenants on that are good for the next couple of years, and then after those couple of years, they can renegotiate the rates. So real quick, I did add ADC, Agree Realty Corp. I remember I had Store in here. They were purchased or bought off by someone else. So I do have Agree Realty here, and they're also a monthly dividend payer, just like Realty Income Corp. So that was, to me, kind of striking because no other REIT that I know of that's, a safer bet, not going to just implode on itself, is doing something like that. Now, the dividend is not going to be, something extravagant, but it is a 4.3% yield, which I like. That to me is pretty attractive. And the REIT's been around for quite some time. So it does have a history. It's not something that's just going to hike their dividend and then stop dividend payments, right? A lot of the bad REITs out there, what they'll do is they'll halt distributions or cut their dividends or whatever, right? And use an investor. That kind of sucks, because why else would you invest into real estate other than to get a return? And, on top of a declining share price, now you just lost your distribution or your dividend. So, that would be enough for me to exit. But ADC does not have a history of ever halting their dividend or stopping or cutting their dividend. So that was attractive to me. And I still got my good old Spirit Realty Capital, still invested in them. And yeah, this is nothing new over here. Again, very boring business models. So I kind of like it. All right, moving on. We have storage REITs, probably the most boring business model out there. They purchase land, they put storage units on it, and then they rent those storage units out, right? Of course, there's a lot more. They automate a lot of the stuff, put in better management, better marketing. So I enjoy these companies. Like I said, they've been good stewards of my money. I think CubeSmart was, I think it was actually Public Storage that tried to purchase CubeSmart, and CubeSmart's been hit with a couple offers to purchase the entire REIT, but they keep saying no. So I think that is probably why this REIT's still doing relatively well. And, again, boring business models, nothing exciting here. The good thing, because, and I'll tell you why, as opposed to like a multifamily apartment complex, where you're dealing with the tenants, the turnover, and all the things that tenants bring, either problems or evictions or this or that. In storage, you have also in multifamily, you have, or single family homes, you have boilers, roofs, maintenance costs, CapEx costs, repavement of parking lots, redoing the fences, changing out windows, locks, repainting the entire interior, as opposed to storage where it's just a flat foundation, a concrete foundation, if that, 4 sheets of metal, to build your box, a roof, and then a bunch of rivets, and there's your storage unit, right? It's a very, very simple thing. And people can come in, they don't need to be escorted there. They either get a key card or key code to get into the facility. They take their stuff out, put their stuff in, whatever have you, and then they leave, and they're charged 75, $100 for the month, sometimes even less than that, like $50 a month, and they get their rents raised probably every couple or every year, when their lease comes due. And it's just a phenomenal business model, very boring, but the like public storage has actually outperformed the S&P 500 index. I think over the last, I want to say 10, no, that's wrong. I think I want to say over the last 20 years, they actually outperformed. So again, it's a very simple business model, and I like it, and that's why I invest into public storage. All right, moving on. We have manufactured housing. Manufactured housing, I'm not going to sit here and pretend I know everything, but basically manufactured housing is, small living accommodations, right? Smaller living accommodations. They're not exactly houses. They're fabricated homes, right? Usually like a trailer. And what REITs do is they'll purchase, either the land, someone, they'll put up a bunch of these manufactured homes. They'll build nice little communities, and, people basically rent those trailers, right? Rent those homes. And again, a very boring business model, nothing super sexy or exciting about it. And, these are just two great companies. SUI has a really good history of compounding and raising their dividend and being responsible. So I have no problem putting money into SUI. ELS is a close number 2. Very good company, very responsible management, and they do exactly the same thing as SUI. So it's kind of a no-brainer for me to invest in both of those REITs. All right, moving on, we have data center REITs. So cards on the table, I did used to have Equinix, and if I'm pronouncing that right, I did used to have Equinix REIT, and I sold out of it because there was a financial analyst that was talking about the CEO, if I'm not mistaken, or the CAO, selling a lot of their shares, which is kind of questionable. And that was enough to spark them to basically exit the investment. And Equinix is a great data center REIT. Don't get me wrong. They've been around since the 90s. Very responsible. Never cut their dividend. Never stopped their distribution, and just overall great REIT. But I don't know. It was enough to scare me. Anyways, maybe that's what it was. It was just a fear thing. But I didn't want to, because this analyst has been really good with his calls and his research. And I saw no reason to stay in Equinix if the CEO was selling a lot of their shares. So that was enough for me to get out. DLR has been having some troubles because their data centers are not producing, or I'm sorry, they're not leasing new space. So they sold off recently a big data center for about 530 mil, if I'm not mistaken. They sold off a huge data center. And they plan to use that money, and for a profit too, but they plan to use that money to purchase new data centers, redevelop them, lease them out, and then sell them, right? That's basically DLR's business plan at the moment. And DLR is one of those REIT darlings that was all the rage in 2020 and 2021. And the reason why was, as I mentioned in my other videos, was because of Netflix. Netflix, everyone's staying at home, Hulu, everyone's doing their Zoom calls. All that stuff has to go through a data center somewhere. And, this was almost treated like a tech stock. It just did really well. And, here we are, and now it's just kind of been going down. But I think DLR has more room to grow. And I think they're very responsible, and they're eliminating a lot of their high interest debt. So I think they're good stewards of my money. And I think right now, just because of the entire REIT sector is in a massive sell-off, I believe that DLR will eventually recover. And until then, I'm more than happy to wait while I collect a 4.7% 4.7% dividend, and continue buying shares at a very good bargain. Don't hold me to this. This could be a riskier type of investment, but again, only time will tell. But for me, I think DLR is a sure thing for me. So let's get back into the REITs, and I'll explain these two here in a moment after I get through my equity REITs. All right, so we have strip centers. I still have Regency and FRT, or Federal Realty Trust Investment Trust, and these are just two REITs that purchase or develop or own strip centers, right? And a strip center could be a massive complex or a massive area that has everything from retail stores to restaurants or high-end restaurants to grocery stores to apartments to any movie theaters and anything and everything in between. So in Boston, Federal Realty Trust, they developed Assembly Row, and Assembly Row was a huge area of shopping, retail, restaurants, movie theater, apartments, right? It's a very beautiful area, redeveloped. That whole area used to look like a dump, and they redeveloped it into something extremely nice. So that's basically what these two are. There's nothing super sexy about them. They're not the next Facebook or Meta or VR or whatever. They're just real estate developers and real estate companies that purchase real estate and rent them out. Nothing crazy about these guys, but they do pay a nice 4.7% dividend. So I've been kind of loading up on them where I can. And Regency is no different. FRT, I believe, is in the S&P 500, and they're, if I'm not mistaken, a dividend king as well. So again, something to be said for real estate investment trusts. All right, we're moving into the biotech labs. Just real quick, I've been investing into Alexandria Real Estate. A lot of people lump this in with office REITs because there's not a huge sector for biotech. So that is kind of the reason why they're being sold off. But Alexandria Real Estate is a great REIT, and they have never cut their dividend, never cut their distributions, never stopped their distributions or halted it. And they have a great management team. They are continuing to lease space to pharmaceuticals or life sciences and things like that. These are spaces that have like laboratories, but also office spaces. So, like I mentioned earlier, if you're a scientist, you got to go into work. I mean, you can't take your lab to your home. So where else are you going to do this important lab work? You're going to do it in an area that's built for it. So I'm guessing a lot of analysts, they list Alexandria Real Estate as nothing more than an office REIT, which is why it's lumped in with the huge sell-off. But I think over the long term, Alexandria Real Estate will return to its all-time highs. And while I wait, I will continue to collect a nice little dividend of 4.3%. And I'm sure it'll grow in the future. But again, this is real estate. This is probably I wouldn't say that the sexiest one, but it's probably one of the sexiest ones. Single family homes, I don't think it needs any introduction. This Invitation Homes had this for quite a while, and this was a REIT that just purchases single family homes, and they infuse technology to make the management much more easier to do, because owning a portfolio of 100 homes, for example, is a lot to manage. So what they do is they'll incorporate technology into their home rental experience, which is a recipe for success, I think. Warren Buffett famously said that, if you could own 100 homes and have technology with it, I'm paraphrasing, of course, that would make for, a really good investment. I think I did an introduction on Invitation Homes somewhere in my YouTube channel. I have the clip where Warren Buffett mentions that. All right, casino and gambling. Still invested into Vici. Nothing really extravagant about them. They're still, I don't know if they completed their merger with MGM yet, But with Vici, it's gaming leisure, so casinos, casino hotels, that type of stuff. Basically, like just leisure. They're based in Las Vegas, and this was kind of more of a higher risk play for me than anything. But it seems to be working out. Uh, it's been a long time since I looked at an investor presentation for Vici, to be honest. Probably not the best thing to do. I wouldn't recommend not looking at your investments, at least once a quarter. But Vici is just, I read a lot of analysts' research on it, and all signs point to they're doing great, and just to keep, that they're going to be one of the major players in the REIT space for casino and gambling. The other ones being, oh boy, I think OGI or OGLI, I can't remember, but yeah, the other one was MGM, but they obviously purchased MGM. All right, last but not least is a cannabis REIT. This is the high risk play. This is this is as sexy real estate as you can get, right? This is the one mired in controversy was the legalization of cannabis throughout the United States, and no one wants to lend to cannabis growers, right? Because banks, big banks, institutional banks, they're not going to lend on that. And the same goes for where you're going to be growing this stuff, right? Where you're going to be growing and storing your cannabis farms. And that's basically where innovative industrial properties comes into play, because they will not only lease the space, but they have leases for the cannabis growers. Because again, you, as a cannabis grower, the way I understand it is you're coming in, pretty much without any investment, because you don't have any bank loans. A lot of banks won't lend on cannabis. So innovative industrial properties basically works out a lease with the growers or with the cannabis distributors or whatever have you on their leases. They come up with some very creative terms. So IIPR was also a Wall Street darling for a little bit. I wouldn't call it quite a meme stock, but I wouldn't also call it, a hype stock either. But it had quite a huge jump from 18 all the way into 21. This was like around the time of the pot stocks, right? Like pot stocks were growing or gaining a lot of momentum. And then, here comes basically into 2022. Well, this is 2021. Yeah, this is 2022, and they just basically just been on a downward trend. Higher risk play for sure. I think over the next couple of years, things will level out. Banking, loans, and regulations will be a lot more favorable for REITs. For cannabis growers, and this REIT will be able to get some of that. I don't even know what to call it. We'll be able to not take advantage, but we'll be able to see better success, if that, with cannabis growers. So anyways, yeah, sorry for that. It's been a long day. So anyways, with that, this is where we're at with IIPR. I'm still going to continue buying it, but maybe not in huge amounts, because again, it is more of a higher risk play and a longer term risk play. All right. Anyways, back to the income portfolio. Let's take a look at mortgage REITs and BDCs. So mortgage REITs, exceptionally high risk plays. Like you got to be really careful what you do in the mortgage REIT space. A lot of YouTubers just say, "Oh, buy this one. It has 15% dividend, yield. It's crazy good," and that is so dumb. Same thing with BDCs. There's a lot of YouTubers out there that get sucked into the mouth-watering yields, right? So this is the portfolio. Let's take a look at one of those really popular ones, and that's Maine, right? This is a monthly dividend payer, 6.9%, really awesome. But again, you got to be careful when you purchase these things, or when you purchase these companies, because they're a little more volatile than one might think. And you don't want to just buy and dollar cost average these, because then you could always be operating, or always be having the company in the red, right? You want to buy it when it's cheaper, so you can at least have some capital growth. Some people are like, no, just dollar cost average the thing. I don't think that's a smart idea in my opinion. Same thing for gain. It's a monthly dividend pair. Oh wow, 7.38%. Buy as much as dollar cost average. No, that's again kind of dumb. SLRC is the same thing. Again, mouth-watering dividend yield, and it's my highest holding in the portfolio, but that's because I've been buying it while it's relatively cheap. All right, so what do all these companies do? Basically, a BDC stands for business development company, right? They lend capital to companies who would otherwise not be able to get a traditional loan from a bank. Think of them as kind of like VC firms. At least that's how I kind of interpret them. They basically lend to high-risk companies, and they do have a lot of high-risk companies that go bankrupt, but they also have, high-risk plays that, turn a profit. And that's how, while they're making the loans to the companies are paying the interest on that loan, and this is where these business development companies come from. Right, so that's how they make their profit. They're making their profit off the interest, off the loans from who they loaned the money to. All right, so I'm not going to pretend that I know every single company by heart like I do REITs, because all these companies, I don't. I follow a couple analysts on Seeking Alpha, and that's kind of how I designed this portfolio, because I wanted more income for this portfolio. I wanted to boost the total yield for this portfolio. But, I know that BDCs is not my forte. It's not my thing. That's why I keep the allocation really small. I wouldn't recommend anyone buy into these unless you really know what you're doing, unless you really understand the company and where they're headed. Because valuing BDCs is, at least the way I tried to, is it's very complicated. You need to understand monetary policy, interest rates, the banking sector, and really dive deep into their books to really understand the company. All right, mortgage REITs. So same thing. I have 3 sectors in here: originator, service REITs, commercial M REITs, and agency REITs. Basically, all these REITs are, they create loans and then they loan them out to companies, or they loan them out for to purchase real estate, right? These are the banks. These are the companies that loan out commercial loans for apartments, for cell towers, and industrial warehouses, and all those other sectors. Excuse me. So they're mortgage companies. Thank you, Penny Mac, for reminding me. So they're mortgage companies. And again, I'm not going to pretend to know everything about these 3 companies. Again, I follow unapologetically. I follow a couple different Seeking Alpha financial analysts that do the research, and I kind of pick from that research what I think makes sense for me. So I won't give them a shout out because I don't want to sound like a sponsor, being sponsored by them, but I also don't want to steer anyone in the wrong direction. You got to kind of just do your own research for that. Blackstone Mortgage Trust, Granite Point Mortgage Trust. I used to invest in GPMT way back in, I think, 18, 19, and I sold out and recouped the cash. I sold at a huge profit, well, huge, relatively speaking. And then I just kind of never invested in them again. But mortgage REITs are exceptionally high-risk plays, really, really high-risk plays. Blackstone Mortgage Trust, mouth-watering 12.78% dividend yield. But again, if you dollar cost average, you're always going to be in the red, right? If you can deal with that, and this pays quarterly, if you could deal with it, then fine. And these guys, all these mortgage REITs are probably just one crisis away from not being able to pay any dividends. So again, you gotta be real careful when you buy into these companies. The 17.37% yield, gee Louise. Again, these are mouth-watering. Be careful what you buy into. Don't just buy into anything. All right, that's my disclaimer. For agency REITs, Dynex Capital, again, very small allocation. I think this is a monthly payer as well. Yeah, look at that, 12.94% dividend yield. Man, yeah, if But again, if you're always operating in the red and you don't care about your capital appreciation, then, do what you think is the best. But I would advise you against that. All right. That's going to do it for this portfolio update. I know it was a long one, but I really wanted to catch up and kind of let you guys know what I've been up to. I've been focused mostly on real estate, investing into real estate syndications as of late. And, I've also been dollar cost averaging REITs, consolidating a lot of my investment portfolio. And, I'm pretty excited for this portfolio because if I continue buying these REITs at huge discounts and, relative to what their NAVs are, and I know that sounds really cool and really technical, but their NAVs are their net asset value. So like if, a REIT owns, I don't know, like $100 billion in real estate, maybe that's too much, $100 million in real estate. And there's a whole bunch of math that happens to basically determine their share price, which tells you how much you're actually getting it for based on the share price of its fair net asset value. I could be butchering all of that. I'm sure there's going to be a REIT expert in there that's going to say, well, you make no sense. Please forgive me. Anyways, where was I going? Yeah. So what I was trying to say is that I'm going to continue buying these REITs at a discount relative to their net asset values because I believe that in the future, interest rates will go down at some point, maybe in the next couple of years, 2 years, I think. And then once these REITs recover, I mean, if you had $100 REIT that went down to $70 and you kept buying the REIT at $70, by the time it recovers, just for it to recover, right, it's going to be a 30% gain on any money you bought, any shares you bought within that window. And then that's not including any of the actual appreciation once we're back in a bull market again. So if you're buying shares cheap now, imagine what it'll be in the future. And that's what I'm betting on. I'm betting on mostly these equity REITs. Again, these are really boring companies. There's nothing exciting about them. They're really just boring. They just buy real estate and rent them out, and then they collect rents. So again, I think in the future, this portfolio will grow very well. It'll continue to produce a very nice dividend. Currently, I'm making, according to Qualtrim, which is Joseph Carlson's software. I recommend anyone check it out. Joseph Carlson has his own channel. I recommend anyone check him out. He's a very, very smart person. I really enjoy his content. He was the one that inspired me to do this. So if anyone wants to check out his Qualtrim, according to his Qualtrim, I am making about $7,500 a year in just dividend income. And I'm hoping to get that to $10,000, hopefully by the end of this year. We will see. But that's going to be doing it for this video. I know it was a very long one. I hope you guys enjoyed it. Let me know what you guys think down below. Tell me, what are you guys investing in today? Have you guys sold your REITs? Are you guys even still investing in REITs? Are you guys investing in tech stocks, AI stocks? Like, what are you guys doing? I want to know. Anyways, all the best. Good luck, guys. Happy investing. Be great.